Hello and welcome to this weekly market recap for the week ending Wednesday, June 18th, 2025. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com. It's a pleasure to be with all of you again today. Just had another Fed meeting conclude. 2 o'clock this afternoon, we got the Fed decision that they would keep interest rates steady, Fed funds rate steady. And of course, right afterwards, we got a little bit of a pop, and then the market sold off, which most of us should be getting used to at this point. Seems like every time Fed Chief Powell has the stage, the market sells off. And quite honestly, I'm not surprised. I thought, there were a couple clues that were telling me maybe this time might be different, but it wasn't. The Fed, again, I think was showing a little bit more hawkish behavior and continues to kick the can down the road as far as rate cuts go. And I think that was why the market struggled a little bit after the announcement. My problem, I know many of you have seen me rant on and on about the Fed in the past. And if you don't like those rants, you might want to turn the video off now because I'm about to go into another one. I was listening to the press conference afterwards, and I can't help but notice how much this Fed chief likes to waffle back and forth, back and forth. There was a question that came up and said, the Fed had, Fed Chief Powell had talked about the fact that, looking ahead, it looks like, inflation could move higher again. They don't know for sure, but there's going to be an impact felt by the tariffs, but they don't know how much. And all of that, kind of makes sense. But question came up and said in December, the Fed cut rates even though they knew tariffs were coming. And so basically the question was, why back then did you see tariffs coming and you still decided to cut rates? And now you think you see, the tariffs coming. So far, it's been pretty benign, but you see tariffs coming now and you don't cut rates. Anyway, what the Fed said was that, there was more clarity with inflation. Now, we have seen the Fed talk about, I've heard Fed Chief Powell say that, we're data dependent. Now, to me, data dependent, when data comes out, it's not data for today. It's data that's in our past. It's in our rearview mirror. So data dependent to me is waiting for the actual data to come out and make decisions off of it. But over the past 3 years, he's had data. He's been watching, for a while. Remember, inflation was up at 6.7%. The core CPI annual rate was 6.7%. And he wanted to see a sustainable move back down toward his 2% target. And we watched every single month as it kept going lower and lower and lower. And the data pointed to him perhaps thinking about, cutting rates again, but he didn't. He just kept holding off, saying that they were going to be data dependent. Anyway, now in today's press conference, he made a point that said, we need to look ahead. With all the data that's been coming out that has been supporting cutting rates as far as economic weakness, as far as no, tick up in inflation, why wouldn't they use this data? If you're data dependent, why wouldn't you make the decision to cut now? And then the Fed chief said, well, you have to look out. The Fed has to look out ahead. So forget about what I said about being data dependent and looking at what the data is coming out and telling us right now. Now the Fed has to look ahead. Which is it? That's all. Which is it? You were data dependent and now you're looking ahead. And the problem is the Fed's looking ahead and can't decide what's going to happen. They don't know. So, just from my perspective, and I think from Wall Street's perspective as well, it certainly comes across like this Fed doesn't know what the heck it's doing. That's my take on it. I'm honestly growing a little bit tired of watching him every Fed meeting just kind of go back and forth on what he's seeing and how the Fed's deciding what to do. Is it data dependent or are you looking ahead? Which one is it? Anyhow, that's that. I'm not going to guarantee that's my rant for the day, but that's probably most of it. And at one point when he started talking about that, was answering those questions, the market was just complete. Well, relatively speaking, versus the rest of the day, the market really started getting hit in the afternoon. I think it was around 2:30 or so. Maybe it was a little bit later than that. Anyhow, let's take a look at what happened over the course of last week and get off of this topic. The Nasdaq, you can see, was the best performer, and I'm looking Wednesday's close to Wednesday's close. We come on here midweek, so if I'm looking for on a weekly basis, we got to go back Wednesday's close last week to today's close, which is Wednesday. And I know many of you are getting this video on Thursday, but anyhow, Nasdaq over the course of last week lost about 2/3 of 1%, same as the roughly same as the S&P 500. Mid caps, transports, Russell 2000, Dow Jones, you can see just a little bit worse. Many of those losing more than 1% over the course of the last week. Moving on to the sectors, again, over the last week, we saw energy. Of course, with Middle East tensions rising, crude oil prices have really shot up, and as a result, many of the energy names have been bought, and we've seen some pretty significant gains in energy here in recent trading sessions. Technology also finished up for the last week. So even though the market pulled back, we're still seeing money rotating into technology. Not exactly what you want to see if you're bearish and believe the market's going to go lower. Why would you want to be moving into technology? So that's certainly one of the big questions that I would have if I was in the bearish camp, which I am not. I believe the market goes higher in time. I think we're going to break out all-time highs around the corner, maybe even with this upcoming earnings season. That's what I'm looking for. To the downside, or at least underperforming the S&P 500, you can see discretionary, consumer discretionary, rough week last week, down about 2%, which was worse than the consumer staples drop of 1.3. So clearly discretionary was the area that was getting hit the hardest among the consumer stocks. S&P 500, I generally will look at a daily chart for 1 year. But since this is a weekly analysis, I thought, well, let's stretch this out over 3 years and look at a weekly chart. S&P 500, we had those negative divergences. We went back down below the center line. We kind of reset everything. And now we've got another uptrend going. The PPO, weekly PPO, back up above the zero line, showing that bullish momentum is starting to accelerate. And even though the 20-week moving average, we saw death cross below the 50-week moving average, we've come back up and clearly now back higher with a golden cross. And so on a weekly chart, we've got bullish configuration. We've got price action above the 20-day, which is also above the above the 20-week moving average, which is also above the 50-week moving average. And so I think that this is showing more and more bullishness. And as far as the weekly chart's concerned, I think 5,800 or so would be an area to watch. Both moving averages just a little bit below 5,800, so maybe give a little bit of room to the downside. But that's where I think selling, looking at this chart, that's where I would expect selling to maybe start to subside. Nasdaq weekly chart, same thing, threatening all-time highs. We came right up, got within about 0.5% of an all-time high after losing, and falling back into the bear market from February to April. We've come all the way back up and gotten back almost every single penny of that drop to the downside. And you can see a very strong and strengthening weekly PPO on the NDX chart. And then finally, look at the IWM weekly. This one, not nearly as strong, not back up to where we were. But I think part of that is because, we were doing pretty well in the fourth quarter back when rate cuts were on the table. And we were still seeing rate cuts. But as soon as that changed and the Fed started talking more about inflation and the fear of inflation going higher and the tariffs, many of those small cap names have struggled. But I do see a downtrend line that's now been broken. We've gone up. We've tested that 50-week moving average. And so far on pullbacks, we're trying to hang on to the 20-week moving average, which is rising. Another breakout above about the 216 level, I think on this weekly chart would really start to paint a bullish picture for the small caps. Now, I say that, if you look at the weekly volume as well on the way back up, it's been very strong. And you can see we've been closing out many of the weeks at least getting back up into this 205 to 210 area. We closed out, it looks like, at 6 weeks in a row in positive territory and finishing near the highs on many of those weeks. So it's been looking like pretty strong action in the small caps, even though they've been lagging. One other thing I wanted to point out here on the daily chart is looking at the AD line on the IWM. We just made a breakout, and this is something I think is really important. When we were going sideways on the IWM, this goes back to 2019 and 2020, where we couldn't break out, and eventually we broke down with the pandemic. Notice through that period, the AD line was rising, showing that there was actual accumulation taking place. And what followed that? One of the biggest runs that we've ever seen in small caps. We rose in 1 year from under 90 on the IWM to over to, probably to about the 220 area. That was about 130% in 1 year. I want to show you this other period. See this sideways action here on the IWM for a year, maybe a year and a half? Here is where we were seeing the accumulation distribution line again rising. Even though price action wasn't going anywhere, it appeared like we were seeing accumulation. What happened on the heels of that? Another big advance, this time from about 160, maybe a little below that, above 240. That was more than a 50% rise in a year. And now, what are we doing now? We're starting to break out again on this AD line, showing signs of accumulation, even though price action is way below where we were previously. So I'm arguing that we've got rate cuts coming, and IWM, these small cap stocks, are being accumulated. And I think in time, we are going to see this bottom where we've seen a rally. I think that's going to continue and maybe even accelerate. That's what I continue to look for. But we do want to see that breakout above about 215, 216 to confirm that. Another area of the market, we talked about crude oil prices jumping as a result of the Middle East tensions. We've gone all the way back up to 75. We're pretty close to a downtrend line. It'll be interesting to see if we can get back up to 80 and through 80. In the meantime, I just wanted to point out that energy, the XLE, relative to the S&P 500, has been going down during this period when crude oil has been going down. So as crude oil goes down, now here recently it's been jumping to the upside. We got a little bit of relative strength, not a lot, but I just want to point out that the correlation between the direction of crude oil prices and the direction of energy relative to the S&P 500 tends to go in the same direction. This blue shaded area shows you when the correlation is positive and higher than 0.5. The red shaded area shows you when you have the opposite, when you have inverse correlation, where they go opposite one another. We've, over the past 20 years, we haven't really gone into this area down here, meaning that for the most part, whatever is going on with crude oil prices over longer periods of time, that's generally how energy is going to perform. So that's why I think getting back up and through 80 could be a signal that maybe we're going to start to see some outperformance in energy. If we can't do that and we start to roll back over, then I think we got further problems ahead with energy. All right, one last thing I want to talk about, and I bring this up from time to time. We have one advantage over Wall Street, the big Wall Street firms, and that is if we get upset about the market, we want out, it's really easy. We can go in and we can just hit market orders and exit everything in seconds, or if you have multiple accounts, maybe minutes. Wall Street can't do that. Wall Street owns millions of shares, billions of dollars worth of some companies. And if they want to get out, they've got to rely on market makers to do it over time. So what we see is at market tops, this is where a lot of the manipulation comes in the market. At market tops, you will see a final leg to the upside, and you will start to see deterioration in a lot of the aggressive ratios, the sustainability ratios that we like to follow at earnings beats. So at the very last push to the upside on February 19th, when we topped, look at the QQQ relative to the spider, started to roll over. Discretionary versus staples rolled over big time. Russell 1000 growth. This is large cap growth versus large cap value rolled over big time. So in other words, money's rotating away from growth as we're starting or as we're setting that final high. Same thing with mid cap growth. It topped earlier in February and then absolutely just imploded. And small cap took a little bit of time, couple months, but it too was deteriorating as the S&P 500 was setting that final high to the upside. Down at the bottom, and by the way, let me just show you. Oh, let's talk about the bottom. The bottom, we saw a lot of these hollow candles, a lot of accumulation, which is why I called a market bottom back shortly after that April 7th low. I wanted to show you this article that I wrote. This is on February 23rd, where I had already told members at Earnings Beats I got out of everything at the end of January. I didn't like the way the market was setting up, and all I needed was confirmation that a top was in place. February 23rd, I wrote the top's confirmed, and now it's just a matter of how low we go. And that top came 2 days after this high right here. Once we started to roll over and we saw massive rotation out of discretionary versus staples, game over. So getting out at the top, getting back in at the bottom pays dividends. You have to understand the manipulation in the market that takes place. If you like what we do at Earnings Beats, I got a couple things for you to think about here. One would be we have a 30-day no-cost trial for our paid membership. So you could check that out. Also, we have a free newsletter. If you just want to, if you like what we do, you like our approach to the market, I think you'll love this free newsletter. Comes out twice a week. Name and email address, hit that subscribe button, and you're good to go. You will literally be joining tens of thousands of other fellow traders and investors who obviously see a lot of benefit in our free newsletter. So check that out. Now, got a big event coming up on Saturday, June 28th. So it's a week from this Saturday. It's free. Everybody's invited. But you do need to go to a landing page on our website and sign up. Space is limited. We may have to end up turning away some folks. So you want to make sure you get registered early. Name, email address, hit the submit button. Now, if you're watching this video, you can go into the description. There will be a link that will take you to this page. And make sure you get registered. Even if you're not going to be available on Saturday, June 28th at 10 a.m., you still want to sign up, because if you sign up, we'll send you a recording of the event. If you don't sign up, we have no way of sending anything. If you're on your mobile device, simply scan the QR code that's on your screen right now, and that will take you to this landing page so you can sign up via your phone. All right, a couple more things. We're going to wrap this thing up. First of all, I just want to say I think that the dollar is poised for a major rally. I have been tracking the 10-year Treasury, the U.S. 10-year Treasury yield versus the German 10-year Treasury yield. And historically, over time, when our yield is either moving up faster than Germany's or it's moving down slower than Germany's, that net yield, it goes up. And when it goes up, the US dollar tends to go right up with it. Now, what I've done here is I've circled some of these inverse relationships where we've seen, the net between the US and Germany 10-year Treasury yield is going one direction, and we have the dollar index starts to go in another direction. And that's where you see all these highlighted areas. In every single one of these cases, the resolution has been for the dollar to reverse. Now, if you look at where we are right now, we've got the difference between the US 10-year Treasury yield and Germany's 10-year Treasury yield. That has been going up probably for about the last 3 months or so. But the US dollar has been going down. So you can see that on this correlation between the two, you can see it's moved into negative territory now. It hasn't gone down into this red shaded area, but if we do get down there, or when we get down there, what that has meant in the past is that the dollar will reverse. So in other words, the yields are telling us the dollar should be advancing and the dollar is not, creating what is now an inverse correlation. The past has taught us that the way that this has corrected itself in the past is the dollar turns around and follows what the yields are telling us. So we are sitting down at a pretty key area on the dollar index, right around 98. I think if you were to connect across and connect this low, we would be sitting almost right on that channel line or that trend line. And in the past, just around this 100 area, maybe just a little bit below, has been a key area of support. We're down there testing that area right now. I think we're going to see a big push back to the upside in the dollar. It's what I believe. One last thing about interest rates is that a lot of times we'll start to see the 1 month Treasury yield move before the Fed raises or cuts. Perfect example back in 2022. Remember, the Fed said inflation was transitory, short term, didn't need to do anything because it was going to go away. They were late to that party. And you can see that the 1 month Treasury actually started moving up late February, early March. The meeting didn't take place where there was the actual raise until the middle part of March. So the 1 month Treasury was starting to point us in the right direction. In April, before the May 3rd, 4th of 2022 is the next meeting. And you can see once again, we had a big move up, probably about 50 basis points in the 1 month Treasury yield prior to that Fed meeting. And what they do, they ended up raising rates 50 basis points. And so, anyhow, it's kind of given us an advance warning. When in 2024, remember, we finally started getting rate cuts at that September meeting? Well, we kind of topped and started rolling over maybe at the end of July and into August, and certainly early September before that rate cut was coming. So right now it looks like we're starting to roll over, kind of like where we were maybe back in July of 2024. But our next meeting, the next Fed meeting, is going to be in July. And if starting in July, you start to see this 1 month Treasury yield roll over and start to go lower, that, in my opinion, could be an advanced signal that the Fed's going to cut. I just wanted to point that out because the Treasury market starts getting a sense of what the Fed's up to and what the Fed's going to do. And they have a pretty good track record of predicting it as it gets closer and closer. So keep an eye on this 1 month Treasury yield. It's the dollar sign UST, US Treasury, 1 month, 1M. And so I would continue. I'd keep this on my charts to check, at least every couple of days and just see what's going on in that Treasury market. Because as we get closer and closer, we don't have another Fed meeting until the end of July. So probably as we start July, or maybe even start of earnings season, we're going to want to keep an eye on this, see if it starts to move lower. If it does, in my opinion, the bond market is starting to call a cut for the July meeting. Based on what the Fed said today, I would think it's going to probably be the September meeting. I'm just telling you, let's watch this because this gives a pretty good clue. Last thing I want to talk about, here's one of our latest chart lists. We just started doing this about 3 or 4 weeks ago. It's called the Leading Stocks and Leading Industry Groups chart list. And this has on it some of the best momentum stocks in the market right now. This is how these stocks have performed over the last week. And you can see many of these stocks at the top have crushed the S&P. Let me remind you of what the S&P 500 did over the course of last week. It was down a little more than 2/3 of 1%, and all of the major indices were in the red. And yet you can see on this chart list, we had a 20% winner, 15% winner, 8% winner, 8% winner, and so forth down the line. Anyhow, I just wanted to point it out because if you do start your trial, this is one of the chart lists you'll get. We update this every single week to get leading stocks and leading industry groups. All right, that's essentially it for me today. I want to thank everybody for tuning in. Hey, I can't tell the Fed what to do. I have my own opinions, but we got to wait until the Fed does what it does. In the meantime, what impact is that going to have on the market? I don't know. Second half of June can be a little bit iffy. And so, with that, we got Max Payne options expiring this Friday. That can cause a little bit of problem for the market heading into the end of the month and into next week for options. So anyway, we got some signals that say short term we could see a pullback, but my signals are telling me that eventually we're going higher. So I would be using any kind of weakness as an opportunity to jump into this market. Anyhow, have a great rest of your week, everybody. Tomorrow or today, if you're watching the video, the market is closed for Juneteenth Day. We'll be back open on Friday and then business as usual going into next week. Have a great week, everybody, and weekend. Happy trading.